Now it is a pleasure to introduce the International Taxation Panel. Globalization and international tax justice, challenges and innovation for domestic revenue mobilization in developing countries. And it is a pleasure to give the floor to the leader of Tax Justice Network Norway, Sigrid Jacobsen.
Thank you. Important information first. We will end this session at 6:45, so that you will have enough time to go to your hotels and freshen up before dinner. Very happy to be here. I'm the Executive Director of Tax Justice Network Norway. We are also a part of a global alliance of organizations and institutions and trade unions working on tax justice issues. All states have responsibilities towards their citizens to provide security, basic needs like health and education. But governments then need to collect revenue, taxes from individuals and businesses to generate income to provide these services. But this has proven to become an increasingly difficult task. We see that capital is flowing out of developing countries to areas with lower tax or even zero tax. And these havens, these tax havens, have proven to be an extremely efficient place to hide the wealth and profits of individuals and multinational corporations, and well hidden from the taxman. At the same time, we have seen a new wave of international cooperation against trying to combat tax evasion and tax avoidance. However, is this new wave, is it enough? Or are the new rules in international taxation actually working for developing countries? Are we already, can we see signs of already losing faith in these new initiatives to combat tax evasion? And on the more, we will also, one of the more also important questions, we have the rules that we have, and within the existing rules, do the developing countries have a leeway or possibilities to increase their taxing rights through the existing rules? These are some of the questions that we will explore today, and the aim of the plenary panel is to present and discuss the research frontier of tax havens, international taxation, and elite behavior. The main emphasis is on how international tax rules affect developing countries, including effects on domestic revenue mobilization and income distribution, and possible ways the current challenges can be mitigated. And with us today, we will have three speakers. We have Professorial Fellow Mick from the Institute of Development Studies in the UK. He's also the CEO of the International Centre for Tax and Development, the ICTD. We also have research professor Odd-Helge Fjeldstad from the Christian Michelsen Institute here in Bergen, and the African Tax Institute from the University of Pretoria, and Associate Director Ngina Mutava from Strathmore Tax Research Centre in Nairobi. So they will each hold a 20-minute presentation each. After each presentation, we will open up for just a few questions, maybe one or two from the audience, to clarify, for clarifications or short comments. And in the end, the rest of the time, after the three presentations have ended, we will have plenty of time for more questions. And you can then ask your questions in two ways, either through this innovative, what is it called, Slido? I'm seeing it the other way from the back here, .com, quite easy to use. Or you can just raise your hand, and we'll try to combine the two ways to give comments. So, without further ado, I would like to welcome Mick to the floor.
Thank you, Sigrid, and good afternoon, everyone. Is this working correctly? You can hear? Okay, very good. We hope, among the three of us, that we're going to give you a fairly integrated presentation. The agenda here is vast. What I'm going to do is give you an introductory talk focusing on what I'm going to call the international tax system, which in effect means the system for taxing cross-border economic transactions. How did it get to be where it is? And it's a system that, as Sigrid has said, in which developing countries generally are much disadvantaged and exploited. So 2 parts: how did it get where it is, and then what is happening at present. And then Odd-Helge and Catherine will focus more on developing countries. I'm going to really talk about the international system. I'm going to make 2 assumptions. One is that the majority of you know rather little about this subject and therefore will appreciate some introduction. And the second is that some of you will know a lot about it and you will be able to pick holes in what I say, which is most welcome. And I say it's welcome because this so-called system is incredibly complex. And it's large, and it has many actors, and those actors have different positions. And it's genuinely very difficult to get an overall sense of what's happening in this system, not least because a great deal of it is covert, if not secret. So I'm very willing to be corrected on this. And I should make it clear in the beginning, when I talk about the international tax system, this is not system with a capital S. We do not have, an international tax organization like a World Trade Organization that sets the rules for this system. This system is a very complex mixture of international agreements and treaties and soft law and hard law and practice and everything else. So it will be obvious to you, from what I've just said, that the rules, the operational rules of the system, were never carved in stone and they were never handed down by any god to society to follow. These have been constructed by man, increasingly by women, but mostly by men. And therefore, because these rules are constructed by men, people in an unequal world, these rules are unequal. Very simply, one can say that from the 1920s, when the current system began to be developed, it really developed 2 important biases. And I'm not going to talk here about many aspects of this, like tax treaties that Catherine is going to talk about later. The 2 biases are, in the first place, there was a general bias in favor of what the economists call capital exporting countries. That is, countries which were home to big companies that were investing in the rest of the world. And I'm not even going to explain how that bias worked, but you can well appreciate that if we take the United Kingdom as an example in the 1920s, the firm Cadbury's that used to make chocolates, now disappeared, has been taken over, used to sell chocolate fairly widely. It was to the advantage of Cadbury's as a company located in Britain and to the British government that they would have greater taxing rights than the government of Bulgaria, where Cadbury's was selling chocolate, for example. So there was a general bias in favor of capital exporting companies, but also increasingly over time, as the system became more complex and we had more and more economic transactions, the system was biased in favor of those who were able to create or exploit loopholes to evade or avoid tax. And also, amongst those, these are companies, they're rich individuals, and a very large number of well-paid lawyers and accountants who benefited and still benefit from that system. So those are the 2 biases from which we start. The original loophole was a place we call Switzerland in the 1920s and 30s. It was really the only significant loophole in the world. But these loopholes have expanded in a very big way, and especially since the 1960s with the globalization of the global economy. Tax evasion and avoidance became a bigger and bigger industry. But the other thing that happened as this system became generalized and expanded was that these 2 original biases began to rub up against and conflict with one another. When the system was originally created, the governments and companies of the rich world or the OECD world or whatever term you want to use were very happy with the biases in favor of capital exporting companies themselves, and they continue to be happy with that. But increasingly, they found that they were part of a system in which they were losing control. Because from the 1960s onwards in particular, we got the beginnings of a big growth of what we later began to call tax havens, which is basically jurisdictions which in various ways enabled and facilitated tax evasion and tax avoidance. So while, if we take, Cadbury's as the example, Cadbury's was no longer taking all its profits back to the United Kingdom, but it was probably putting some of its profits in the British Virgin Islands or the Cayman Islands or Jersey or Guernsey or one of many other jurisdictions in the world. So a certain amount of tension built into the system here. And partly because of that, the governments of the richer countries began to take some steps to protect themselves against tax evasion and avoidance as it affected them. Now, for purposes of this talk here, I can jump over about 40 years of history and come to the current century. Because it's really in this century when things began to change quite significantly. And to simplify even more, two very important things changed. And the first thing that changed, starting, say, 15 years ago or a little bit more, was that we got an enormous amount of campaigning by many organizations and many journalists, Tax Justice Network, etc., that exposed to the public what was actually happening here, or at least many dimensions of what was happening here. It's still, of course, very obscure to us, but 15 years ago, the discovery that some large company was really avoiding taxes on a large scale by using a tax haven, when first exposed, would justify a newspaper headline. These days, if you put a newspaper headline, Google is avoiding tax, you think, well, so what? What's the point of a headline? We all know they're avoiding tax. So there's been a big change in public perceptions, and all tribute here to those campaigning organizations, especially, but not only Tax Justice Network, that have been responsible for this. But the other thing that happened was that just about 10 years ago, we had the fiscal crisis. Well, first the financial crisis, which then translated for most OECD governments into a fiscal crisis. They bailed out a lot of banks, and they were short of revenue. And they, therefore, began to look more closely at tax evasion and avoidance issues. And within a few years of that crisis, there was a fair degree of consensus among the OECD countries and indeed among the G20 that for both fiscal and political reasons, they better both do something about these large-scale avoidance and evasion and be seen to be doing something, because it was both a fiscal problem and a political problem. And very simply, what the most important thing they did is to charge the OECD with coming up with a plan to do something about this. And the OECD was given 2 years to do this, between 2013 and 2015. It was called the BEPS process, where BEPS stands for base erosion and profit shifting. That's the technical definition of the problem. Base erosion means I don't tell you what I'm earning, so you can't tax me. And profit shifting means I take my profits from Norway to the Cayman Islands, so you can't tax me. So we had the OECD process. The OECD reported in 2015. And at the time, there was an awful lot of discussion of the issues. Now, let's just talk a little bit more about how the problem was defined. The OECD and the G20 basically defined this as a tax problem, and a tax evasion and a tax avoidance problem. On the whole, they separately treated issues of money laundering, and banks shifting money around, dirty or suspect money around the world as a sort of separate category of activities. But so the language of the OECD countries, this is a tax issue. In developing countries, and particularly in Africa, this is slightly differently framed. And someone, I'm not sure who, invented the concept of illicit financial flows. And the concept of illicit financial flows is essentially putting together problems of tax evasion and tax avoidance, both by companies and by rich individuals, and putting into that same package problems of money laundering and transfer of money from one country to another in a sort of somewhat covert fashion. Now, the rhetoric of illicit financial flows is rather powerful, and it's caught on very powerfully in Africa in particular. There was the Mbeki Commission, and it's now sort of broadly accepted as a word of truth in Africa about the volume of illicit financial flows. But although it's rhetorically powerful, there is no clear definition of what an illicit financial flow is, and there is no very clear way of measuring illicit financial flows. And it's important to stress that any headline figure you see for illicit financial flows is not the same as a figure of tax that's being lost to Africa or whoever else it is. These figures are very significantly different, but they are sometimes conflated. If anyone says, as they do occasionally say, anyone whose heart is in the right place says, do you know that illicit financial flows from Africa are 10 times the level of aid, and therefore Africa could get, if it just could stop illicit financial flows, it could get 10 times as much revenue as aid. Well, I wouldn't say nonsense. I would say this is extreme wishful thinking. The volumes are nothing like that. So there's a very quick bit of background. What I want to talk about now is what I think is happening internationally over this system and over reform of this system. And I'm going to zip through rather quickly about 8 points. First, as I just said, there was this BEPS process that the OECD undertook between 2013 and 2015. It made some quite sensible suggestions. Some of them are being taken up. One should just clarify that its suggestions are patches on the current system. I mean, it completely rejected the idea of trying to rework the current system at all. And at the time of the BEPS discussions, I think many of us thought that this was going to be a big kind of decision, and what came out of the BEPS process would really stand for at least 5–10 years. There would be some change in the system, but it's not like that. The debate continues just as vigorously as it did at the time of BEPS. So all the same issues that were discussed before are up now. So in that sense, the debate is continuing, and most people think there are a lot of unresolved problems. Secondly, and if you like, slightly more on the positive side, the biggest single recommendation from BEPS was what's called country-by-country reporting, which essentially means that the largest transnational corporations are required to report in a sort of to a very limited constituency their activities and their profits in accounting terms according to every jurisdiction in which they operate. Basically, their business accounts are being disaggregated country by country. When this was first proposed, the private sector was up in arms and said, this is terrible, it's going to cost us a fortune to do this. This is absolutely awful. While I have a lot of sympathy with the private sector over some respects of tax reform, I have no sympathy over that point. As various people pointed out, any company that does not maintain accounts or enough information to produce accounts, jurisdiction by jurisdiction in which it operates, is clearly not doing its job, and the management should be sacked. You need to maintain that information anyway. So producing country-by-country reports is really not a big deal. The challenges to this now are saying, well, first, it's only the really big companies, so it doesn't affect most of them. Secondly, this information is being reported, to a limited constituency only for tax purposes. This is not public. But I think there's a lot of optimism amongst tax campaigners that this probably is the thin end of the wedge, in the sense that once it's known that this information is available, then there's going to be a lot of public pressure to expand it and make it more widely available. So fairly positive. Thirdly, and I think this is possibly the most important single change so far, I mentioned earlier, we don't have a World Tax Organization, but the attitude of the OECD to questions of who runs the world tax system has changed very significantly. The OECD basically represents the rich world. It represents most of the world's economy, most transactions. In many senses, it has been an equivalent to a global tax organization simply because it dominates, and what the OECD says, to a large degree, the rest of the world has to follow. But during the BEPS process, the OECD was subjected to some really, really vigorous lobbying on behalf of developing countries, saying, you are making decisions on our behalf and we are not represented. Equally importantly, the OECD will have been very aware that there were many other, in this increasingly multipolar world, there are other jurisdictions, like India, like China, like Brazil, etc., that are increasingly able to say, well, we like some OECD rules, we don't like others. We'll accept them, we'll reject them. So the OECD knew it was facing a lot of both immediate challenges and long-term competition. So it has made great efforts to try to involve other countries in its tax discussions, and other jurisdictions, non-OECD members, can now be affiliated for tax purposes. So there has been a significant step in some ways towards the OECD becoming the World Tax Organization, but it's still very contested. I think that's very important. I think that's the biggest single political change. Related, although it wasn't an important part of the BEPS process, after the BEPS process, particularly last year, this year, there has been very considerable movement at the OECD level on introducing what's called automatic exchange of information or exchange of information among tax authorities for tax purposes. I don't have time to explain this, but you can simply imagine, if you represent the tax authorities of the world and you're trying to tax transnational actors, if it's easy for any one of you to access anyone else for you and say, well, tell us, we think X company is doing X or Y, what do you have on them? It makes your job very much easier. There are many questions about this, and the biggest question, I don't know if Odd-Helge will have time to take it up, is how possible it is for small, poorly resourced tax jurisdictions in low-income countries actually to use this resource which is becoming available. But it is becoming available, so there is success. There has been a certain amount of movement in sort of cleaning up the money laundering business, the bad banks, introducing registers of beneficial ownership. And to summarize grossly, I would say that the tax haven activities carried out in small Caribbean islands that we traditionally talked about have been significantly curtailed. And increasingly, tax haven activities take place in rich OECD countries. They take place in the United States and Britain and Luxembourg and Netherlands and Ireland. So, if you like, tax havens have been internalized. Another point, something that didn't happen, was that ideas of radically changing the international tax system were rejected and I think are not currently on the agenda. I can talk about those later if one wants. 1 minute, okay. But finally, on what's happening, it's important to bear in mind that there is a sort of nano-sized elephant in the global room, or actually there are trillions and trillions of them, which is the shift to the digital and knowledge economies. You can define these in various ways, but this means, value lies principally in knowledge and data, online transactions, the differences between products and services is being elided, etc. This, in the long run, is a major change to the current system because the current system does depend on someone having the capacity to in accounting terms, attribute both economic activities and profits to particular jurisdictions, Norway versus Sweden. But the more we shift to knowledge and digital economies, the more difficult it is to actually make that attribution. So in the long run, that is the really biggest, I think, threat to the current system. Sorry, actually, one more point I should have added. If you want to look at the politics of the current system, I'll take one extra minute. The biggest political conflict over tax at present does not involve developing countries at all, although that's what we talk about. The biggest single political conflict over tax lies in the fact that a large number of American companies, especially the big tech companies, the Googles and Facebooks and Amazon, etc., have, because of a quirk in the US tax system, massive accumulated profits that they are keeping in the rest of the world and not repatriating to the US because they'd have to pay a lot of tax on them. And here we have all these vast profits sitting elsewhere in the world. And this has, in addition to other reasons, this motivates the Europeans generally, but especially the European Commission, to be, to salivate and think, well, not only is, Google cheating us of taxes, but they're keeping all these profits there, and we want a share of them. So if you look at, some of the really strong words that have gone on recently, it's been attempts by the European Commission to grab some of those, and the response of the US Treasury, very firm to say, hands off, this is our money. That's where probably the most interesting political action will take place. So, in conclusion, the politics, the system is not in equilibrium, it's still changing. I think the politics have really changed, and I don't think developing countries can be as overtly marginalized in political decision-making in future as they can in the past. Unfortunately, there is no sign, or no significant sign, of collective action by groups of developing countries to deal with these issues, because that could greatly change their bargaining power in a range of issues. And finally, and most skeptically, it's not clear to me how far these, on the whole, positive changes in politics and policy either will be or are reflected in underlying patterns of economic and tax behavior. First, there is still an awful lot of tax competition out there. Governments still will often turn a blind eye to tax evasion by companies if that's a good way of, persuading companies to invest. Secondly, you read in, say, 2010 how all those Swiss banks have been cleaned up and they're no longer money laundering on a large scale. And then you read in 2016 how the same Swiss banks are money laundering on a large scale. And when I say Swiss, I could mean any banks. It's not just Swiss. And absolutely finally, and I will quote a recent newspaper story, between 2010 and 2017, offshore assets held in the British Virgin Islands doubled. There might be a particular quirky reason for this, but those kind of figures make me think if assets are doubling, maybe there's something going on here which is not quite so benign as it looks from the point of view of the OECD. Thank you.
Thank you, Mick. So, as I promised, two short questions for Mick now, initially, and we have room for others afterwards. If you have any, we're just taking the raise hand method now. Okay, great. Yeah, one question here.
We touched on an issue close to my heart towards the end there, Mick. Could you elaborate very briefly, perhaps, on the tension between developed countries' desire to recoup as much as possible of that tax, which is so tantalizingly there, and the interests of the developing world in a more equitable tax justice? These are not the same processes, and I would see them somewhat in tension with each other.
No, I don't think they are the same processes. We might get Odd-Helge to talk about that later, but As it stands, you know, many of the moves in the OECD, and particularly those moves which are directed at the big American tech companies, are basically intended that we, I mean not Ireland, but many other governments should take revenue from you, Ireland, and then from American companies for us. But it's not clear that low-income countries either currently would have much of a claim to that revenue, because those big American tech companies have on the whole, very low profits in low-income countries. And it's not clear that the institutions we are creating to get some of that money are going to be at all useful to developing countries. And the key point here is that any of these techniques that involve more sophisticated use of information obviously require relatively sophisticated tax administrations. They need resources, you know, they need trained people, they need IT systems and everything else. And it is genuinely not clear whether those measures we're taking that we think are global public goods are really terribly useful for low-income countries. And I say that not because I know the answer, but I think it's a question that it has been asked, and I think we need to continue to ask it.
So, and one question there.
You started out, Mike Spears from Copenhagen, you started out talking about the 1920s, and then I started thinking about the Bretton Woods system and the general agreement on tariffs and trade. Tariffs are sort of taxes. Where is the United Nations in all this?
This could possibly be quite a contentious question, because in 2015, was it the conference on the financing of the Sustainable Development Goals in Addis, a major push was made by the tax justice activists and many other people to strengthen the UN Tax Committee. The UN has a tax committee and has some subcommittees. It has almost no resources, and a major push was made by the activists and indeed by many governments of many developing countries to say that you know, the OECD is illegitimate here. You know, it does not represent the world. The UN represents the world, and therefore the UN Tax Committee should eventually be upgraded, so let's upgrade it a little. I find it genuinely difficult to take a sort of policy position on this, and the reason I find it genuinely difficult is this. The OECD might be unrepresentative, but it's influential. It gets stuff done. The UN Tax Committee is very, very small and very, very weak. And frankly, it doesn't get stuff done, and it's not its fault. You know, I mean, it's almost been, you know, one person and one assistant till recently, with people who attend the UN Tax Committees often paid by the private sector. I mean, the UN Tax Committee is in one sense even possibly represents the collective interest worse than the OECD, because it's often the big four who pay people to go there. So, you know, there's a genuine dilemma here, and it seems to me that the OECD will face anyway many challenges, including from China, India, etc. Whether or not we should be boosting the UN as another challenge to the OECD is, I don't know what the answer is to that one.
And you kind of answered the question that came in here. Will we ever see a UN tax body? But we'll let that question linger. And thank you, Mick. Then I will welcome Odd-Helge up for his presentation. And I'll find your presentation.
Yeah, good afternoon. Can you hear me? Yes. Yeah, good. As Mick also pointed out clearly, we have learned in recent years a great deal about the many ways in which the international tax system facilitates tax avoidance and evasion by transnational companies and wealthy individuals. And there is no shortage of examples of transnational enterprises paying little of the tax that they would otherwise owe by siphoning off profits to tax havens. And similarly, we know a great deal about how rich people in poor countries possess great wealth and hide it offshore, beyond the reach of the national tax and judicial authorities. We, for instance, know that African governments lose a lot of revenue. Much of the reference point for me is very much the work I'm doing over many years in a number of African countries. And we also know that, well, we know this is a big challenge, but we don't know how big this problem is in relation to other tax challenges facing the continent with respect to domestic revenue mobilization by domestic taxpayers and so on. And we know still very little about how or what can be done with it. A lot of attempts, a lot of initiatives have been launched, but are they working? For instance, should African countries put a great deal of effort into trying to change the rules of the international tax game? Well, what are their power? Do they have power to do that, to influence? Very, very questionable. But we see attempts by individual countries in Africa to change the rule of the game. What is happening now in Tanzania, the fight between President Magufuli and Akasa Mining Company, is quite interesting also in this perspective. But would that or similar efforts by governments scare off potential investors? Should governments in Africa or other low-income regions try to close the many loopholes found in their domestic tax system instead? What are the options for African countries to raise domestic revenues? And a key question in that perspective is also, are they losing the faith in the international tax system? And that is the point of departure for my presentation here. Firstly, briefly touch upon the effects of the international tax system and the domestic revenue mobilization. And again, the reference point is low-income African countries. I think this partly complements what Mick already have addressed. Then I move into how the existing financial environment and tax system influence the role of banks and other enablers of capital flight. There is a big industry out there of facilitators for tax evasion, avoidance, and capital flight. Third, this is also complementary to what Mick has talked about. What is being done internationally to fix the international tax system? And how are African countries reacting to, in particular, the OECD initiatives? And then what now? What are the options further? Well, firstly, effects of the international tax system on the domestic revenue system. Well, we know that many multinational companies, they pay little tax in the countries they operate. And as Mick also mentioned, this is not a unique developing country problem. The Googles and Facebook and Amazons and Microsoft, not least, it's a big problem for Western tax administrations. In many African countries, the main challenge is related to extractive sectors, particularly mining, also telecommunications, but also other sectors. But this is a problem which affects many countries. And in that perspective, it makes sense that one try to move towards international initiatives which fits all. But is that actually the case, that the initiatives are fitting all countries, independent of their context? In many ways, the corporate income tax system is a fiction. It is not globalized to not adapted to the globalized economy. The corporate income tax system is developed for individual countries, for nation states. It has not been adapted to the globalization which have taken place over the last 20, 30 years, where multinational companies, they have subsidiaries all over and can do profit shifting, they can do transfer costs to high cost jurisdiction and profits to low tax jurisdiction. So corporate income taxes is not at all adapted to the realities we face now with the multinational, with a globalized economic system. And just to summarize some of the points which Mick made related to multinational companies, we have the very complex company structures, we have creative accounting, aggressive tax planning, tax havens already mentioned as a destination for tax avoidance and evasion. And then we have also the growing facilitation industry, the big four in particular, advisory, consulting, audit company, PricewaterhouseCoopers, KPMG, Deloitte, Ernst & Young. We have the international banks and wealth managers. I come back to that. But there is also a major challenge with respect to the tax behavior of the wealthy elite in poor countries. They are also mobile internationally, like multinational companies. And a large share of their income comes in the form of capital gains on investments. And they can also employ advisors, expensive advisors, to assist them in their tax avoidance strategies. And they are either part of the political elite or they cooperate very closely with them. And we also know that the efforts by so-called high net worth individuals to avoid taxes, not least in poor countries, they have accelerated with the spread of globalization. Zuckman, in his book from 2015, he estimates that has estimated, and of course the figures are always questionable, but these are probably the most credible figures we have for the time being. That in 2015, the total financial wealth owned by foreigners in Swiss banks were $2,300 billion US. And of this, more than 150 billion came from African countries, which made Africa the continent hardest hit by tax evasion in this context. There are direct effects of tax evasion and avoidance by multinational companies and high net worth individuals. Well, firstly, of course, revenue loss for governments. But we also see the rent-seeking activities and also divert scarce resources from the domestic economy and from productive activities. And it's also very likely that it have negative impacts on income distribution and wealth distribution, and these are direct effects. And this is also documented in a number of studies, including work by Andy Kumana and Boyce, but also others are working in this area. And it's also an additional point that many countries in Africa still receive significant amounts of foreign aid and external loans, which probably is, in some contexts, are less than what they are losing in tax revenues. And then you have the indirect effects of tax evasion and avoidance. Firstly, domestic companies in Tanzania or Zambia, where they know or have a perception at least that the wealthy multinational companies pay little tax. It's a perception. And there is also reality, some realities behind it. And this has impacts on their own tax paying behavior. So what we observe is, for instance, massive lobbying for tax exemptions by domestic companies. Also, tax exemptions are granted multinational companies and foreign investors, but also in a number of countries, domestic companies in constructive sectors and other sectors are granted exemption. This is also a part of the game to level the playing field. And in our work in Tanzania and Zambia, we also find that, in surveys that a perception of widespread tax evasion by the wealthy ones and foreign investors, foreign companies, also legitimizes tax avoidance and evasion. And it has also impacts on institutions in poor countries, on government accountability, citizen participation, and the views of the state. For instance, a study by my colleague Arne Vik and Ivar Kolstad in a Research Council-funded project which I'm leading, they find that information about massive tax evasion by the elite may have no or negative effect on political participation. You recall all what happened in Iceland when the Panama Papers revealed that the Prime Minister had secret accounts at British Virgin Island. The whole population mobilized and demanded him to go. In the work by Fjeldstad and Vik in Tanzania, we find that is not happening. It's actually the opposite happening. There's a resignation, apathy. Okay, we cannot do anything with it. These people up there are doing what they will. Anyway, so it contributes to undermine the confidence in the political institutions and faith in the social contract. This is a citation from the East African Community, the Council on Trade, Industry, Finance and Investment from 2009. So it's very clear that from this and many other statements that Africans and African governments, African civil service, they are very well aware about the costs imposed by this base erosion and profit shifting mechanisms taking place, eroding the revenue base. But at the same time, we see that such political statements, they rarely match the practical tax policy. There are massive exemptions granted to domestic and foreign companies. In Tanzania, for instance, estimates suggest that up to 4%, the value in lost revenues of tax exemption may represent up to 4% of GDP. And that's a lot when the tax to GDP ratio is 13%. And in addition, we see very rare examples where high net worth individuals are taxed. There is an interesting study by ICD now in Uganda, which shows that there has been some attempts to addressing this challenge of taxing high net worth individuals. Then I move over to the role of the facilitators, which I think has been largely ignored. There is some research coming up, but without these facilitators, this system could not have been maintained and worked and expanding. We have, and I just focus on three categories of the facilitators here: the international banks and finance institutions, the big four, I'll mention PricewaterhouseCoopers, etc., and the wealth managers. The Panama Papers from last year identified 500 banks as enablers of capital flight, and the largest banks in the world, like the HSBC, UBS, Credit Suisse, and so on, they are major players here. And there are a number of cases where these banks have been convicted in the US and also in other countries for facilitating tax evasion, aggressive tax planning. These are big players. The big four, they have offices in 150 countries, including all the major tax havens. And they have also repeatedly been fined by OECD countries for facilitating tax evasion and aggressive tax avoidance. These companies are, their offices are growing, expanding in most developing countries. In Tanzania, for instance, there are PricewaterhouseCoopers have 200 employees. They have offices both in Dar es Salaam and in Arusha. The same, the other three are also represented there, and you have also a kind of a forest of other related companies. And they are also operating both as tax planners for companies and wealthy individuals, but also in many cases as advisors for government. In a British Parliament Public Accounts Committee report from 2015, PricewaterhouseCoopers activities were described as nothing short of promotion of tax avoidance and on an industrial scale. Then we have the wealth managers. There are about 20,000 of them. Brooke Carrington from Copenhagen Business School has written about that. And they help clients to violate the spirit of the laws while remaining formally compliant. And because what the elites want is not just tax avoidance, but also law avoidance. And for very ultra mobile private capital, national laws are in general just a set of shopping opportunities. So why are governments not putting a stop to this? No, there are massive conflicts of interest at a personal level, also within government. The wealth managers have direct access to top politicians, to the highest levels of government, both onshore and offshore. So what is being done internationally? This has been addressed by Mick. There are a lot of initiatives, no shortage of that. I just listed a number of them, including the BEPS initiative, which Mick referred to. And some of these initiatives are really fairly recent, but others have worked for quite some years. And that also indicates that efforts so far have been relatively unsuccessful, which is also illustrated by the large leaks, the Swiss leak, the Lux leak, and the Panama leaks. They contain actions and capital flows that have happened after the introduction of some of these initiatives. For instance, the jurisdictions used by Mossack Fonseca, the company in Panama, to help clients hide their wealth were predominantly those who were then regarded by the Global Forum as largely compliant. In particular, the British Virgin Islands and Bahamas and the Seychelles. Yeah, so here are some statements showing, okay, the days are numbered for secret accounts, 1991. 2001, Forbes, private banking, rest in peace. 2009, at the G20 meeting, era of bank secrecy is over. 2011, OECD announced the new initiative significantly raised the probability of detecting tax evasion and greatly improve. I've left some space here because there will come more statements like this. But the bank and financial sector, they prove to be experts in adapting to the new laws and regulations. I think I'm more pessimistic than Mick what is achievable here and how poor countries can manage in this setting. So, reactions by African countries to the OECD and rich country initiatives. There are major concerns from lower income countries with respect to these OECD and G20-led initiatives, because they generally do not reflect their particular needs and circumstances. The BEPS process, they have tended to produce reforms that favor OECD interests, and they fail often to address the particular concerns of lower income countries. And the BEPS recommendation, they will also increase. They will not reduce the complexity of international tax routes. They are backed by tens of thousands of pages of technical documentation. And when the Americans, the US government officials are on board, we know it will be completely, this will just be meat for lawyers. Will be so complex that, that it is very hard to manage without involvement of exactly the tax advisors and consultants. This is creating a new market, expanding market for the facilitators of tax evasion. When it comes to automatic exchange of information, which Mick mentioned, I think there are big challenges facing poor countries, African countries. Firstly, modern IT systems and availability of electronic documentation is in scarce supply. Capacity and time to respond to an increasing flow of inquiries, scarce capacity in place. Their ability to handle the more complicated inquiries, very limited. And many types of trust will remain accepted and not covered by the BEPS agreement. So this is just some statements. The first one is from the Global Forum OECD run, saying, okay, mainly the blame is of poor countries because there is lack of political will and lack of awareness. Then a counter-argument by the Michael Leonard, who's secretary for UN Committee of Experts, says, well, the problem may be that these new initiatives are not firstly, adapted to the specific developing country context, and they are not brought into the table. There are some moves there, but very, very slowly and reluctant also to involve them in the process. So, what now? Firstly, I think it's important for poor countries to be quite selective on how to allocate resources to get involved in the BEPS process. Michael Dust, in an ICD paper, he suggests that they should instead focus on their limited administrative resources to develop their domestic tax system. The VAT, the income tax on individuals, excise duties, and so on, which is still in not a very good shape. Focusing on the rich has had limited success. Maybe one should apply second-best approaches, taxing visible assets like property and vehicles, etc. More focus on the facilitators is definitely required, but this also requires joint coordinated efforts. We know still very little about these so-called enablers, wealth managers, and so on. Power and politics, how to hold the elite accountable. That's a major challenge to get things moving. And finally, there has been also suggesting that one should also aim for an international convention against tax havens. We know that they are creating a lot of problem, undermining other countries' tax base, revenue base with all the costs. They are also hiding money from criminal organizations and so on and so on. Why should we accept that small islands, 10,000 or 20,000 people, take control over the revenues from much larger countries? This was also one suggestion by the Norwegian Commission on Tax Havens and Development, which I was a member of, 2009, turned down. But just 2-3 years ago, I think 300 top economists, including Nobel Prize winner, took up this issue, that this is something which should be considered, but it requires international coordination. Thank you.
Thank you, Odd-Helge. And if we have 2 quick questions for Odd-Helge before we take the last presentation? No, we can. Then okay. I suggest that we go on to Catherine. I will find your presentation as you.
So I apologize, my voice disappeared for the first time in 10 years. So Murphy's Law at work, I'm sorry. So I'm supposed to cover on tax treaties, and the assumption is that most of you don't know too much about tax treaties. If you do know a lot, please don't hit me because I'm trying very hard to simplify it. In Africa, we love talking about food. Everything is about food in Africa. Weddings, what we do is eat. Funerals, we eat. Anytime there's a function, the function must have food. It doesn't matter what kind of a function it is. So you will forgive me if you're hungry, but I will try and use food analogies in explaining tax treaties. Okay. So, yeah, as I said, if you're hungry, please forgive me. Generally, when you think of tax treaties, the main problem with, the main reason why we need tax treaties is just this. So tax is like a cake. Everybody wants a piece of it. And you only want to share it with the people who are nice to you, right? If it's your birthday, you only invite the people you like and you want to give them pieces of cake so that everybody can be happy. So what happens then when everybody comes and starts eating away at your pieces of cake, After a while, you'll be left with nothing at all, right? So what tax treaties do is they sort of agree. Okay? You have the cake, but you didn't bake it alone. So for example, we have Vodafone in Kenya. It's called Safaricom in Kenya, but we have it in Kenya. But we agree that Kenyans did not necessarily bake that cake for Safaricom alone. So they had the UK, which came and gave us some money, and we started Vodafone in Kenya. So as a result, that cake is not ours alone. So the UK wants to eat part of the cake, and Kenya wants to eat part of the cake as well. If both of them eat the cake, then Safaricom is not going to be left with any money. So because of that, we have a tax treaty which tells us who gets to take which part of the cake. Now, when we were younger, I wouldn't say we used to steal, but I will use a polite word. When we would be leaving school on our way home, there would be these fruits, these trees of fruits on our way home. And every so often we would be tempted. You know, they're so sweet and so succulent, and they're just there. Nobody's eating them except the birds. So every so often we would be tempted to go up the trees, jump over the fence, go up the tree, and eat some of the fruits. Okay? And we would do it as a group. So there would always be the person who's at the top of the tree, picking the fruits and throwing them down. Then there'd always be the person who is walking and just, keeping watch just in case the owner finds us eating the fruits. And of course, there'd also be the person collecting them. Then there'd always be this one child who, if we were caught, would be so willing to tell on us. So once we collected all the fruits, the person at the top of the tree would eat first from the very source. He'd be picking, eating, and then throwing what he doesn't want down. Okay? So that is essentially what source taxation is. So he's at the very top, he is eating the fruits, and then what he doesn't want, he throws down. Then now there's the person who is collecting the fruits. Okay? So that person still gets to get good fruit, but not the best, because the best was eaten by the person at the very top. Then there is the person who has been keeping watch. He will be rewarded. Then, of course, there's the bystander, who is just waiting to tell on you. He would get fruit depending on whether or not we are caught. If we are caught, he's not going to get anything because he's going to tell on us. If we're not caught and something remains, we may give him. Now, in that scenario, the person at the very top of the tree is the source. So the revenue authority at the source technically should eat the best of the fruit. So if a company is operating in your country, you're the one giving them the space, you're the one giving them the land, you're the one giving them protection, all these things, technically they should get the best. Okay? So that is source taxation. Now, that doesn't necessarily always happen. Okay? So what we discuss now is how tax treaties now come and help us in such a situation. Now, I've told you what the tax treaties are. It's to prevent this fight over this cake, okay? So they're just supposed to eliminate double taxation so that once Vodafone makes some money in Kenya, both the Kenyan government and the UK government is not fighting to tax it. As I said, I have many cake similes. Now, when the tax treaties, to understand how they work, you have to go back to when they started. The first one, I think, was started by the Germans. Back in, it was in 1890-something, I forget the exact date. It was signed between the Germans and I think the Austrians, okay? Then the Austrians went ahead and signed another one. Now, this is the 1890s. In the 1890s, while they are coming up with treaties, what do you think the Africans were doing? We were dancing. We were happy. The weather was fantastic. There's a lot of fruits. I'm not saying that we were not thinking. We were trading, of course, but we didn't necessarily need tax treaties at our time. We had other ways of dealing with these issues, and we didn't have a very formal system of tax. We had some form, but not a very, very formal one. So you can imagine, from the 1890s, Europe and the Western countries have been coming up with these treaties, and they've been developing them, while we have been dancing and basking in our very, very delightful weather, which, by the way, is very good. You should come to Kenya and see it. It's very, very good weather. Okay? So they came up with it for two reasons. One, to avoid double taxation, so that if you make money in another country, you're not taxed both in that country and at home. And there's another reason, which I think only developed later on, and I think it's just added on there to make us feel better, which is to reduce tax evasion. I don't think that was the main reason for tax treaties. It's just become a by the way. And now it's touted so that we can take up tax treaties. Now, African countries, once we gained independence, and even before we even gained independence, we started signing tax treaties. And we were told these treaties are very good for you because they will encourage people to come in and invest in your country, because it sort of also provides some level of stability so that you know if you're investing from outside of the country, you know the exact kind of a tax system to expect. So we took it. Now, by the 60s in fact, in the 50s, the OECD had already, well, not necessarily the OECD, the first model that was created for tax treaties was created by the League of Nations. Now, the League of Nations, by then, we were no longer dancing. Then we were fighting. We were fighting for independence, so we were still not there. So they came up with the first one. Then in the 50s, again, they came up with another model, which is what has been built upon by the OECD to now give us the current model that we have. Of course, there have been changes and improvements. And then in the 80s, in the 70s, the UN, that ad hoc tax committee that both Mick and Odd have discussed, decided they needed to help developing countries so that it can reflect the African countries' position. So they sat down and started developing some rules to sort of help the African countries. However, the people who sat in the committee again were the IMF representatives from the big countries. So as you can see, there was again another problem. Now, there's a Nigerian man who says of these processes that if you do not come to the table, then you are part of the menu. Now, the Africans did not come to the table because at first they could not come to the table. They didn't know there was a table. Then once they found out there was a table, they were not allowed to come to the table. Then finally, when they came to the table, the big boys were already there. So after a while, we became part of the menu. And it is our fault in many regards. And I will explain why part of it is largely our fault. I'm not blaming the Europeans only. Please don't stone me. But it is part of the problem of how tax treaties developed. Now, the way tax treaties work is they tell you who can eat which part. So they say, fine, you have this cake, you can eat this part, and you can eat this part. So they allocate taxing rights. And the basis upon which they allocate taxing rights is based on either, one, if there's actually an active activity going on. For example, is there actual mining? Where is the actual mining happening? Or where is the actual farming coming from? For example, Kenya, we don't have, well, now they say we do, but we have not had very many resources, natural resources. So ours has been farming. We produce a lot of tea and a lot of coffee. Incidentally, we don't take as much coffee, but we produce quite a bit of it. So the activity in this case is the farming. So the farming is taking place in Kenya. So generally, the way they allocate it is they say, if there's actually an activity taking place in your country, then you get a right to tax that activity. But it has to be a practical activity. It can't be like providing banking services, a loan, or giving your professional opinions. They say that's not an active activity. That tells you what they think of us professionals. I don't know why they don't think it's an activity. But they don't think it's a real activity. So if you're doing a proper activity, they say the source country should tax it. So in this case, if you're farming in Kenya, for example, the flower farms in Kenya, they're mostly owned by the Dutch. But since they are in Kenya, then Kenya gets first dibs at taxing the profits made from the flowers. Then any passive income, that's dividends, royalties, all these other things, should be taxed at the resident country, meaning the person who is actually giving you the money for the loan, giving you the money for the equity and such things. That sounds all good and dandy. So now, therein lies the problem, because the Western countries or the capital-rich countries are the ones that will give us the money, and therefore they're the ones who generally hold the royalties. They're the ones who will be giving African countries the loans. They're the ones who will be doing all those things. Okay? And the African countries will be mainly where the activity is taking place. Now remember, all these things, with the exception of dividends, the interest, the royalties, the management fees, the technical fees, the banking charges, all these things will reduce the profit which is made in Kenya, for example. So for example, I think the best example would probably be our flower farms. The flowers grow in Kenya. The marketing is done in the Netherlands, or I don't know which place. It's not done in Kenya. And the management is done everywhere. Now, since independence, I don't think that there's any flower farm that has ever paid taxes in Kenya. Okay? And we produce a very, very large portion of the flowers in the world. Okay? And as far as they're concerned, it is because a lot of the fees are being paid to the Netherlands. And it's not wrong. I mean, it's what the law says. The law says if you pay fees, it is a deductible expense, so therefore you can deduct it. So all they're doing is following the law. So there's nothing wrong. That is what the law is. Okay? Now, so that is how, first of all, they are allocated. The other thing that they do is they tell you what can and cannot be taxed. That's what tax treaties tell you as well. They say this can be taxed by this country, and this can be taxed by the other country. But it also tells you what can and cannot be taxed. Now, one of the biggest problems that you will always hear developing countries talking about is there is a fee called the management fee. Management fees and technical fees. It's a very ambiguous term. It doesn't mean anything at all. It could mean, for example, that I sit down and I tell my company, which is in Kenya, that I am going to be employing people on your behalf. So basically what you do when you're in Kenya is you sit down, you tell me I need a HR person. Then I am sitting, say, maybe in Mauritius. I say, oh, you need a HR person? Okay. I pick up the phone. I call a recruiter in Kenya. I tell the recruiter, please get these people a HR person. So the recruiter in Kenya goes around, gets a HR person, then the HR person is brought to you, then you tell Kenya, here, I have brought you a HR person, and then you slap them with a bill. That's a management fee. It's a technical fee. Apparently, you have done something technical that has helped with management, I think. Now, such a fee, depending on the treaty, will not be taxed in Kenya. But it will be deducted in Kenya. So it will reduce the profits which are in Kenya, while increasing the profits which are moving from outside of Kenya. And there are some incomes that are simply completely exempt. The best example is, for example, some certain types of capital gains which will be exempt from being taxed under a treaty. So, for example, there's a huge mall. Kenya, we are very, very excited right now about malls. I know you guys are bored with malls, but let me tell you, Kenya, the biggest thing right now is a mall. A mall is built, we all flock there and just stare. We don't buy anything. We just stand there, stare, take selfies, and then go home. So after a few months, of course, the malls begin to suffer because nobody's actually buying anything. They have a lot of foot traffic, but nobody's buying anything. So one of the biggest malls currently, I think it costs about 2 billion Kenya shillings, which is a lot for us. It is owned, yes, by Kenyans, but it is owned by the parent company that owns it is sitting in Mauritius. Now, the way that our treaty with Mauritius is worded is such that if you sell any immovable property in Kenya, then you will be taxed in Kenya. That makes sense, right? I mean, the mall is in Kenya. So if you sell the mall, you'll be taxed in Kenya. However, it says also that if you sell shares in a company, if you sell the shares of a company, of a mall, I mean of a company that owns immovable property in Kenya, then those shares will only be taxed in the country where you sold them. So in our case, if the parent company of that mall decides they're going to sell the shares, then that transaction cannot be taxed in Kenya. Okay? Clear? I will not even talk about the problem with tax evasion, but they've tried to deal with it in the tax treaties through exchange of information, and I think Odd discussed it. And they've also tried to deal with it by introducing provisions on transfer pricing, which is basically you have to charge each other as if you don't know each other. My transfer pricing lecturer used to say it is witchcraft, because you sit down, you pretend you don't know your sister, then you charge them as if you're not related, so that it can seem like it is a real transaction. So now what is the problem with the treaties the way they are? First, they result in a lot of double non-taxation. Because of the way the treaties are worded, there are so many loopholes in there that there are some companies that end up not paying taxes. For example, I think there was a report on how Diageo didn't pay taxes in Africa for a very, very long time. Now you need to know that Diageo is one of the biggest beer companies in Africa. Now, and if there is something that Africans love other than food, beer is right there, second. Okay? The beer goes with the food. So for you to say that you have not made any money, and especially because in most countries, they were the monopoly. So for years, they say they had not made any money at all. And it was because of all these loopholes that were existing, not just in the tax treaties, but also in the domestic laws as well. So there's a lot of that as well. So there's a lot of double non-taxation. Same thing with the flour companies. When they don't pay taxes in Kenya, it doesn't necessarily mean that they are going to pay the taxes in the Netherlands, because they have found loopholes in ways in which you will end up not paying taxes anywhere. The other thing as well is there's a lot of shifting of profits. because our tax system is 30%. If there is a way in which I can use a treaty so that I end up in a country where my tax rate becomes 0%, I am going to utilize it if I am a company. This is what is happening with the Googles and the Amazons and which other company? Starbucks of the world. That is what they're using because they want to pay as little tax as possible. So they're all shifting profits from these very high tax countries, which African countries tend to be, to low tax countries. And there's a lot of treaty shopping. So you find a lot of people will just go and set up in Mauritius just because. One of my lecturers kept telling us that if you ever go, for example, to the Cayman Islands and ask for, say, a certain company, say maybe assuming that Google is registered there, if you ask for Google at the reception of the registered address, they tell you 1 minute, she opens a drawer and says, yes, this is the office of Google. If you ask for Uber, she goes back to the same drawer and says, yes, this is the office for Uber. Because nothing actually happens there. It's just registered there, there's no activity, there's nothing at all. So because of that, people tend to go and shop in those places and just register for tax purposes. So it sort of beats the whole point of a tax treaty, because a tax treaty is actually supposed to help to solve an issue of tax where the resident is actually doing active business in the other country. But if you're not a resident, I mean, how many people actually live in Mauritius? Very few people. How many people actually live on the Cayman Islands? There are, I mean, are there even 100,000 yet so far? There are very, very few people. So what is being done so far? Somebody has discussed the BEPS process. But again, the BEPS process brought in the African countries at the very end, which is where the Nigerian kept saying, no, we were on the table. But you know, he decided that he must go to the table. That was why he said that. He said he must go to the table so that this time he is not eaten. So they went at the very end, and I think they were only able to give their comments on the arbitration clause, which all African countries have rejected anyway. It doesn't help. Many countries in Africa are beginning to also reduce the loopholes that are existing in their domestic law, because that's the other thing that you have to do. Because that cake, it's not an infinite cake. It has an end. So first, at least if you can make it, I think the reasoning of African countries is, if you can make it big, at least when the other countries come and eat part of it, you'll be left with something. So at least if you can show up your domestic law, it will make the cake much bigger, and at least when the others come and eat part of it, it will help a bit. Not too much, but it will help somewhat. And others are reviewing the tax treaties. Zambia did it. Uganda is currently doing it. I think South Africa did it with Mauritius. We haven't reviewed ours, and ours is another problem all over again. And of course, we're also trying to establish our own models that reflect the African problem, because the issue with African countries is a lot of them are source. People come to us because we have certain things. So if we can at least come up with a model that reflects that, and we can say that this is what we're not willing to take, and this is what we're willing to take. If you can have at least a bare minimum, then you'll be fine. The way my country has been negotiating tax treaties, which is why I blame us as well, is the president wakes up one day and says, I am going to Nigeria. And as he is going to Nigeria, the night before, the person from the revenue authorities is called and told, we are going to Nigeria and we are going to negotiate a tax treaty. The president of Kenya and the president of Nigeria go into the room. They sign a tax treaty. He walks out and tells the Kenyan revenue authority person, please go in and go discuss the details. So there's really no particular model right now as it stands. We don't have a reason why we're negotiating with Nigeria, for example. It could be purely because the Kenyan president likes the president of Nigeria. I mean, really, and it's just good manners. I mean, we're all about good manners. It's good manners to extend favors to each other. Let's just help each other. And we also have a big problem is there's a lot of elite capture. Our politicians tend to be some of the high net worth individuals. For example, our president currently, we keep laughing because he owns a certain county. We have 47 counties, but he owns land that is enough for an entire county. And it's maybe about 40,000 acres of land. And when he was asked, he said that is a personal matter. And it was a willing buyer, willing seller transaction. Of course, he forgot the fact that his father was the first president, and the way he allocated land was he would get into his car, fall asleep and tell the driver to drive. Until the part where he wakes up, he would say, this is my land. Okay? So that is what is going on. Okay? Is there hope? Yes, there is some hope. As I said, ATAF is coming up with its own model. Kenya is currently finally coming up with its own model. So there is some activity that is going on, but it is time, as the others have said, for African countries to stop having a pity party and stand up together and decide what it is that they want to do. And also, nobody forces you to negotiate tax treaties. You don't have to sign. You can just say no. If you have the oil, if you say no, the oil will just stay in the ground until the day someone is willing to come and take it. You don't have to. And you don't have to keep giving away incentives and all these other things. That is all.
Thank you so much. So before I invite all of the panelists up, do we have an initial question for Catherine? Oh, two. Whoa, great. So first there and then up here.
My name is Christine Sevold. I'm a historian, but working on the issue of tax havens. But I would be interested. Stand up, speak louder. Okay. I would be interested to hear more about the issue of Kenya moving into a tax haven. Would you have... the last time I checked, Kenya had plans to move into a tax haven.
Yes.
And thank you for an inspiring talk anyway. Thanks.
I think what you're talking about is the Kenyan government recently, I think as at maybe last month, they passed a new law that effectively sort of creates a tax haven within Nairobi. They're calling it the Nairobi International Financial Center. And what that bill does is effectively, they create secrecy laws. So any bank that is set up there is not under the jurisdiction of the Central Bank of Kenya and is not liable to the banking laws. And they're not, all the information they have is completely confidential. The minister is allowed to give as many incentives as he wants. And the people who sit on the board are the president, the deputy president, and I think the minister of finance. Essentially what they've done is they have taken all the other laws and said, this one space that we have, you can do anything at all that you want, and nobody is going to regulate you, and nobody will ever know what's going on. So there is a certain extent to which they have created a tax haven. But that is what I keep talking about when I say there's a lot of elite capture, because the people who are going to benefit the most are the people who are going to be sitting on that board.
No, I just wanted to say, to ask exactly the same questions about the Nairobi International Financial Center. I think it's not, it's still under scrutiny of the parliament. It's not.
No, it was passed.
It's passed.
Yeah, it was passed. It was passed just before election, because members of parliament at that time, they don't know what's going on. They're all in a hurry, and they've been promised probably to be paid their pension quickly.
These are the midnight votes.
These ones.
But maybe my second question would be, I mean, Ghana has tried exactly the same and has failed.
Yeah.
So I think there is much more to it to become a tax haven than just, having secrecy laws and all that.
I hope it fails.
Do you think that Kenya, I mean, hopefully not, but that Kenya might become a more successful country than Ghana? Or do you hope or think that it might fail?
I would like to hope that it will not be any more successful than Ghana, but I can't assure that. We have our current president and deputy are very, very determined human beings. When they want something, they will get it done at whatever cost. So I can't promise you that it will not succeed, but like you, I hope it will not succeed for the sake of the rest of us. But I have a feeling it will be challenged in court. Kenyans, we love litigation, so I have a feeling it will be challenged in court.
Okay, well, we'll just hold your question and we'll invite the panel up. Odd-Helge and Mick, can you come up and stand by these tables? And you too, please. I will start off with, that's sad, from my magic book of questions from our wonderful audience. So any of you can decide who wants to try to answer. So the question is, do you see tax justice acquiring enough traction to turn into conscious mobilization among citizens to affect countries, especially those that have electoral democracies? Any of you want to comment on that?
I mean, at one level, this is obviously an impossible question to answer. But, I mean, I am a little bit optimistic about this, and there's many things about tax, but I'm partly optimistic because, frankly, there's no choice. You know, I mean, taxing it's a continual battle between people trying to avoid tax and people trying to make them pay tax. I mean, we can't just give up. You know, because if you give up, I mean, it's, you know, they're pushing, you fall right over, so you have to keep fighting this. And if we think about tax justice, this is basically in, you know, rich countries, this is 15 years old or so in terms of, I think Tax Justice Network was formed 2003 or 2004, less than 15 years old. And has made a great deal of progress in that time in some rich countries. Much less progress in low-income countries, including in Africa. But that is no surprise, because, you know, one reason why the tax justice message resonates in Norway and in Britain is that most people pay personal income tax, and therefore talk about taxation, you know, resonates with them in a way that it doesn't in most low-income countries where most people don't pay personal income tax. But at the same time, you know, there are tax justice activists developing in organizations, developing in low-income countries. We have more and more information available about why and how taxes are not being collected and are being evaded by rich people and companies, etc. So, you know, I think we certainly shouldn't give up on this. There's an awful lot of work to do. But, you know, the cost of this is very low. It's actually very good for citizens to find out about taxation and get mobilized about it. You know, they become, even if they don't do anything about tax, they become much better informed citizens and better voters. So, yeah, I'm going to be a little bit optimistic on that one.
Maybe have another. It was kind of a big question that's also on my magic book here. So it goes like this. Do you have a suggestion to a solution which could end all tax evasion?
Is there a solution that can end everything? I mean, you could shut down all the tax havens. A lot of them, and I was asking Mick earlier, I mean, the UK owns the tax haven, some of the tax haven, the French. It seems like a lot of the big countries, each of them have a tax haven on the side. So maybe if they shut them down and they just stopped, that might help. Or maybe if we just, you know, I think there was a suggestion suggested by someone that perhaps we should consider just taxing on turnover. Forget about profits, forget about everything else. If you make a turnover of 500 million, we just tax you on the turnover, a very, very small percentage, maybe 1% or 2%, and then you can go away. Then we won't have this fight of you have management fees, you have technical fees. That way it will just, you know, you just tax at the top level and then move on. But I don't know whether or not the tax evasion can ever be completely eradicated. I don't know.
No, tax evasion has existed as long as there has been small governments, and the oldest history about tax evasion is from the Indian kingdom 300-400 years before BC, and where the advisor of the king, he details 40 ways taxpayers or citizens can cheat the king with respect to taxes. And I was telling this story also to when I started to do tax research in Tanzania 25 years ago, to a senior officer in the that was before the Tanzania Revenue Authority. It was in the Ministry of Finance. I was just curious about how did they managed to evade taxes? What mechanisms were people doing? Because tax evasion was then high on the agenda. Obviously, either my English was bad or I used concepts which didn't understand. And then he said, then I realized I have to exemplify. And then I told this story about this Indian history, the 40 ways the king or the government could be cheated. And this guy, he looked at me and then he shook his. We Tanzanians, we are much smarter than the Indians. We have thousands of ways. And when they plug one hole, we invent 5 new ones. So I think there are big challenges. But what I agree here with what you say, that there is an increasing awareness among many people, citizens, and tax justice and other civil society organizations have contributed. We have also now got very active and productive African organizations like the Africa Tax Administration Forum focusing on these issues. But the challenge is to get the political level, the political leaders to mobilize. Many of the initiatives by ETA, for instance, is driven by bureaucrats. It is not rooted in politics. So without involving the political level, mobilizing them, getting them also on the arena, I think we have big challenges still.
I can maybe follow up with a question. Yes.
Very quickly on that, we'll never prevent tax evasion. It would be a very odd world if we did. People wouldn't be people. But we didn't get very technical in this session. But I'm sure, between the three of us, we could give you a very long list of practical things that governments of developing countries could do to increase their tax revenue. Just domestic. Catherine's just given one. You could require companies to pay either a profits tax or a percentage of their turnover, whichever was the greater or lesser, alternative minimum tax. It's done in Pakistan. It works. It's not a problem. There are many other, you could place more severe limits on the amount of interest that companies are allowed to deduct and when they put their accounts. Because if they're borrowing money from their affiliates overseas, that's a way of transferring money. So you put a limit on that. We could give you a list of 24 ways you could do this. There is no great technical problem on this. The problem is exactly the one that Odd-Helge has just put forward.
I just mentioned that noted that African Union was mentioned, and there's a question here also: what has happened at African Union level after the recommendations of the Mbeki-led high-level panel? Can the African Union play a progressive role in tax justice? I don't know if Catherine wants to.
I don't think that the African Union has. I don't think they have either the capacity or even the willpower to do anything substantial about it. The AU is sort of like a ragtag team. They're not very... First of all, even the funding is a problem amongst themselves. Like, they will not even contribute enough money to sustain themselves. And then, of course, there's the fact that a lot of the people who sit there, because remember, for us in Africa, politics goes with elitism. So what you're asking them to do is actually shoot themselves in the foot. The people who have all this money in Switzerland are the ones who are going to be seated in that AU office or in that AU General Assembly. So you can't, it will be very hard for them to be the ones to initiate it. So unless something drastic happens and politics is divorced from wealth in Africa, I don't see the AU doing anything about it. There's a question there.
Yes, there's a question over there. Can our extra microphone find its way?
People hear me? Yeah. Okay. I'm Alexander. I work at the OECD.
I'm so sorry.
Yeah. So I don't know why I stood up. Sorry. Or you're welcome. But mostly, this is not about the OECD's role in all this. It's a technical question, but Mick just alluded to the importance or the significance of large portions of the population in developed economies paying personal income tax. And if we look at sub-Saharan Africa and we look what the very obvious missing link is, yes, corporate income tax is a very important part of the picture, but in a context of very high informality today and what is likely to be very high levels of informality sustained long into the future, I was just wondering to what extent our panelists are optimistic about the potential for developing personal income tax systems in sub-Saharan Africa.
Okay, interesting question.
I can start. Yeah. Yeah. Can you hear me? Yeah. Yeah, you're right. Personal income tax is very underdeveloped. It's mainly civil servants and people employed in the formal business sector who pay, who are included in the personal income tax system through the pay assurance system. But here we must also take into consideration the income level of people. Poverty is high in many countries. In very many sub-Saharan countries, the income level is so low that it doesn't make sense to introduce any personal income tax. But what we also know is that many people in the informal sector pay a lot of informal taxes, fees, and charges. Substantially. There has been work also by the ICTD on this in West Africa, Sierra Leone, and Ghana, showing that. There has also been work in DRC showing that. Substantial share of income, of people's informal incomes are actually captured through all kinds of informal fees, charges, bribes, whatever. And then in such a system, moving towards a personal income tax, formal income tax, doesn't make much sense. That doesn't imply that there are also many relatively wealthy people who don't pay income tax. Professionals, lawyers, doctors, dentists, and so on. Very low taxes. So there's a big potential. And we have seen some successful attempts in African countries to capture that untaxed tax base. In Uganda, for instance, there has been a project now. It has been coordinated by the Uganda Revenue Authority, by collaboration with ICTD, which actually then ended up with capturing a large chunk of people who also civil servants who had a lot running businesses and not paying taxes on hotels or whatever they were running, and they were captured. So that is also documented in stories. I think one has to move step by step, not targeting the poor ones in the informal sector, but go for the more low-hanging fruits, the professionals and such people.
Okay, so I think we have time for one more question. Okay, two then. We'll take two at one go. So we have one in the middle there first. Go. And this gentleman straight up.
Yes, Christian von Haldenwang from the German Development Institute. Thanks to the three of you for this excellent overview over what has happened and what is going on and what's next. And what we could see from the list Odd-Helge gave us in his presentation is that a lot of progress that has been achieved due to club governance action or unilateral action. And in this sense, there is a big elephant in the room, and I'm referring, of course, to the first orange person becoming president of a country in the world. And the fact that the USA are planning huge reforms. They are discussing, the question is if it's going to be achieved, but they are discussing huge reforms in their tax systems that will, if they succeed in implementing this, will be a real game changer with regard to all this that we are discussing today. And it would be great to hear your thoughts about how to manage a situation where this is looming, at least. Thank you.
Gilles Carbonnier of the Graduate Institute, and I shall add that I'm Swiss. One question is, one of the latest reports of global financial integrity was highlighting that a vast majority of illicit financial flows might accrue from trade mispricing and abusive transfer pricing. And my question is maybe to Mick or the other, is what is being done to really address the misinvoicing of commodity exports and imports and trade mispricing, and is there hope on that front to progress?
Thank you. I will just add on a couple of questions from the magic, my magic pad here.
The first one, Christian.
What do you think about what do you think about tax on all financial transfers as a solution? And is unitary taxation a utopia? Of course, that would need an explanation of what unitary taxation is, which you might not have a lot of time to do. But if the presenters could pick from the questions that came up now in the last round, and this would also serve as your last words, and you can start. Well, we'll start with Odd-Helge again, and we'll move our way through. Yes,
yeah, these are big questions, of course, and there's been a lot of emphasis, for instance, on the GFI study. And the nice thing with the GFI is that they have managed, because they have the big figures, to get headlines, to get this on the agenda. Contributed also with tax justice and others, but the figures they're coming up with are very disputed. And there are massive critique, a lot of misunderstandings. And now I think it's time also to do more serious work on quantification here. Gabriel Zuckman is involved in that, at Alstadsæter from Norway also, and Nils Johannes in Copenhagen doing great work trying to now get up more credible data. Because the danger now is this one is throwing out all these big figures, is that one undermines the credibility of the arguments. But I think, having said that, I think the GFI has also contributed to set it on the agenda. I think the trade mispricing is an important issue. But I think it's not necessarily the major thing. It has been focused on trade mispricing because that is where you can get some data, which of course there are a lot of weaknesses with the data, but one has then made some estimates. But I think there are massive tax evasion through high net worth individuals, both spending, for instance, affluent people investing in properties. You mentioned, Catherine, in the land acquisition in Kenya. We see that wealthy people invest properties all over. It is not captured by the trade mispricing data. I think so the problem with that, I think there are challenges, definitely big challenges, but there are also other major challenges with respect to tax evasion, which one could address, should not forget also to address. When it comes to unitary taxation, taxing that a multinational company now today, it is taxed, their subsidiaries are operating it, so it's taxed, they can then operate with all kinds of trade, transfer mispricing and profit shifting, which we have discussed already. The unitary taxation means that a multinational company should be taxed as a unit. So, and it should be taxed accordingly to their activities and in the country they operated. There's some kind of, so it should be called, the profit should be taxed according to a kind of a formula which refers to the activity of the company where it operates. So that, for instance, and this is a system which some American states have had for many years, California, Arizona, and so on, because there are different tax rates in these different states, and they agreed, okay, one should tax according to a kind of a principle based on fairness, that companies from California operating in Arizona should not be zero tax, but they should also taxed to California. I think it's a very fascinating idea, and also ICDD has done great work with. Sol Picciotto has published around a big program. There is a book on ICD website actually on unitary taxation, examples, cases. But again, maybe because I'm an economist, maybe because I'm from the western part of Norway, I'm still pessimist on these things. I think why, if unitary taxation is such a fantastic tool, why is there so much resistance also from governments to implement it? Why has it not been implemented? So I think there is a need for more political economy research. I think the issue is very much politically the politics around it. But I think it will be a long time before it's really be rolling out all over.
ending there from Odd-Helge, but
yeah, here's more.
Sure. Okay. There is no radical reform of the international tax system on the agenda for the next 10 years. I'm sure about that. But in the longer term, it's quite possible. And I think it's partly for the reasons I gave, especially the knowledge digital economy. It might just prove impossible to carry on taxing the way we're doing. So I think we should be open to the possibility of radical changes. And there are really currently only 2 radical changes that have been set out in any detail. And frankly, there's not much detail for either of them. And one of them, this is the question that Christian asked about, is the destination-based cash flow taxation that was proposed in the United States by the Senate, Republicans in the Senate, and discussed intensively but briefly a few months ago. Now, that system is not global in the sense it could be introduced by one country, but if the United States introduces it, the rest of us would have to adapt. I mean, we couldn't carry on. I mean, my view on this, Christian, is that there will be no significant tax reform in the United States, and even if there is, I think that's just off the agenda now. I mean, a lot of American business lobbied against it, some lobbied for, so I don't think it'll happen. Unitary taxation is more complicated. Odd-Helge has just explained it. You really require a decision either on a global basis or a large group of countries to introduce it. You can't introduce it country by country. So there are, in that sense, all kinds of serious collective action obstacles to introducing it. But it actually is relatively coherent, and as Odd has pointed out, there is a book on our website, the only book on unitary taxation, which does explore the issues. So if you're interested in the solution for the next decade, you can forget it. If you want to talk in the longer term, then it might be interesting.
Like that, a little, pick it up a little bit. So Catherine, can you
I will try and end on a positive note. On the transfer pricing question, I'll give you the Kenyan scenario. It has worked very, very well for us. We have a very, very well-trained transfer pricing department that has actually managed to get quite a bit of money back from what I would call tax evaders. So it is working, but from what I could tell, there's also now talk of changing from the arm's length principle to the formulary apportionment, which again might mean we are back again to square one where we don't know anything. But so far right now, we're doing very well. It's us and South Africa leading the way, and we're doing well. Yeah, so hopefully that's a positive note a bit.
And I was a little bit optimistic on my time. But 5 minutes before time is not bad that either. So a big round of applause to our fantastic presenters.